Welcome to the jungle. What is the stock market? The stock market is like a giant flea market, but on a much grander scale. But instead of used clothes and furniture, companies sell tiny pieces of themselves known as shares. These pieces are called stocks, and they represent ownership in the company. When you buy stock, you own a part of that company. Exciting, right? It's like having a small stake in their success. Think of your favorite store, the one you love to shop at. Maybe it's a big toy company or a tech giant that creates the latest gadgets. Buying stock is like owning a tiny piece of that store, a small part of its operations and profits. You become a part owner, a shareholder. This means you have a say in some company decisions. Now, these companies don't just sell pieces of themselves for no reason. They have big plans. They need money to grow and expand their business operations. They use the money from selling stock to build new factories, develop new products, or hire more employees. This helps them innovate and stay competitive. So the stock market is where companies go to raise money, and it's a crucial part of their growth strategy. And it's where people like you and me can invest in their success, hoping to see our investments grow as the companies thrive. Owning a piece of the pie, buying and selling stocks. It's like owning a piece of a company. Let's say you want to buy stock in that toy company. You see potential in their innovative toys. You believe in their toys, and you think they'll sell well. You imagine kids everywhere loving them. You're betting on their future success. It's an exciting prospect. You can't just walk into the company and buy stock directly, though. It's not that simple. You need a special helper called a broker. They facilitate the buying and selling process. We'll talk more about them later. Brokers play a crucial role in the stock market. When you buy a stock, you're hoping its price will go up. It's all about timing and market trends. If it does, you can sell it for a profit. This is the reward for your investment. That's how you make money in the stock market. It's a game of patience and strategy. But remember, just like the price of a toy can go up, it can go down too. Market fluctuations are common. If the toy company isn't doing well, its stock price might drop. This can be due to various factors. That's the risk you take. Investing always comes with uncertainties, but with careful planning, you can navigate them. Your guide in the ring, brokers and how they work. Remember those brokers we mentioned? They're like tour guides for the stock market. They help you navigate the buying and selling process. Brokers have access to the stock exchanges, where stocks are bought and sold. Think of it like a big auction house for company shares. You tell your broker what stock you want to buy and how much you want to spend. They then execute the trade for you, buying the shares on your behalf. Of course, brokers don't work for free. They charge a small fee for their services called a commission, but they make the process much easier for everyday investors like us. Section 4, keeping score indices and what they tell us. Imagine trying to keep track of the prices of every single toy in the world. Sounds impossible, right? It would be a daunting task, requiring immense effort and time. That's why we have stock indices. They simplify this overwhelming task. A stock index is like a basket of stocks. It groups together a selection of stocks to represent a segment of the market. It tracks the performance of a specific group of companies, providing a snapshot of their collective performance. Think of it like a scorecard for the stock market. Just as a scorecard shows the performance of a sports team, an index shows how well a group of stocks is doing. One famous index is the Dow Jones Industrial Average, often referred to simply as the Dow. It tracks 30 large, well-known companies in the United States like Apple, which is a tech giant, Microsoft, a leader in software, and Coca-Cola, a global beverage company. By watching indices, we can get a general idea of how the market is doing. They act as a barometer for market health. If an index is up, that means most of the companies in that basket are doing well. Conversely, if it's down, it indicates that many of those companies are struggling. Section 5. The sweet taste of success. Dividends explained. Remember how we said owning stock is like owning a piece of a company? Well, sometimes those companies share their profits with their owners. These profit shares are called dividends. They're like little thank you gifts for investing in the company. Not all companies pay dividends. Some companies reinvest all their profits back into the business to grow even bigger. But companies that do pay dividends usually send them out to shareholders every quarter or 4 times a year. It's like getting a bonus check for being a part owner. Section 6. Fasten your seatbelts. Understanding market volatility. The stock market is like a roller coaster. Sometimes it goes up, sometimes it goes down, and sometimes it goes up and down really fast. This up and down movement is called market volatility. It's a normal part of investing. Volatility can be caused by many things like economic news, company earnings reports, or even natural disasters. Remember, investing in the stock market involves risk. Prices can go down as well as up. That's why it's important to do your research and invest for the long term.